This is a Farm Doc Daily webinar. I'm University of Illinois Extension's Todd Gleason. Thank you for joining us today for this top 10 business strategies of 2023 from the folks at FBFM, the farm management folks here in the state of Illinois, Bob Rhea and Brad Zwilling. By the way, if you'd like to visit the FBFM website to learn more about what that record keeping service can do for your farm, you can do that easily enough at fbfm.org. That's fbfm.org. Of course, we always thank our sponsors for the day. They include Compeer Financial, Corteva AgriScience, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers Association, the Illinois Soybean Association as well. Again, this is a Farm Doc Daily webinar, top 10 business strategies for 2023. Brad Zwilling will join us in just a moment, but the executive director for Illinois FBFM, Bob Rhea, is here now to take us through the very first slide. Some changes in tenancy raises some risk. That's number 10 on the top 10 list. Hi, good morning to you, Bob. Thanks for being with us today.
Well, thank you, Todd. Great to be with you. Appreciate all the introductions that you've done there. And housekeeping, get us off and running. We are going to share our top 10 strategies. And maybe here's the disclaimer. This is not based on any really scientific evidence that we've created, but are things we've heard from farm operations over the winter as we've checked in books and done tax plans, worked on analysis reports, things we've heard from our field staff, just things we're aware of in the general economic conditions. And we're decided to maybe summarize some of those for our attendees today to talk about a focus on 2023 going forward. We're now processing all of our 22 data records, and we'll know those results, within a month or so. But we also want to be looking forward, and that's what we're thinking about here today is what are we looking at for 2023? And Brad, this one has several different bullet points on this slide. We'll go ahead and pull those up as about land tenure is the first place that we begin. And Brad's run this chart, and Brad, I'll point our direction to about 2006 when the lines intersected. That was the ethanol mandate began, and look how it's changed from 2006, Brad.
Yeah, we've changed right in 2006. We were about 50% crop shared in 2020 or in 2000, and by 2021, we've completely flipped those. So our cash rent is now about 50% of our acres on an average farm, and about 30% crop share, and the balance of those would be owned acres, and that stayed about the same between 20 to 25% of the average farm in Illinois FBFM as owned acres.
So the big thing has shifted here as we think about what does that mean for our risk assessment. Prior to 2006, the tenant was responsible mostly in Illinois for half the expenses, received half the income, and now that's inverted to where the tenant is responsible for 100% of the operating expenses and has increased their risk to collect all the revenue, but also be required to have a full assessment of all the expenses. Brad, our next slide puts a few bullet points up for us on what these are. So that means the tenant's going to require more capital. We have one question already from the group. What about changes in interest rates affecting the share of expenses? Well, here where the tenant's providing 100% of the capital, let's say it takes $1,000 to put a crop in. Last year, the interest rate was 4%, so that's $40 an acre. This year, the interest rate will use 8%. That's $80 an acre. So an increase of $40 of either borrowed money, but Brad, I think you have the same result of it's your own money because you have some opportunity cost changes too.
Right. Yeah, you're investing into that operation, so you can get that money back and paying it to yourself as we get that crop out of that crop. So
crop insurance is the next thing we mentioned as we have the tenant responsible for 100% of the risk. They have a growing need for crop insurance and at a higher level. We've already mentioned our next point about higher interest costs per acre. That's about a 400 basis point or maybe 100% increase in interest cost per acre in 2023. Price management, we're not good about that at FBFM. That's not our thing. But anything you're doing to protect your price in contracting, hedging, all those will raise gross revenue, Brad.
And I think the key is know what your break-even costs are, and if you can make a penny, you make a penny. So that's how you protect that gross.
Yeah, the very first line item on income statements and our EMA comparative is gross revenue per acre. It's an important number to protect. But here's the good news. If you are the tenant with all of the risk and all of the reward, there are opportunities for higher profit, which has been the case the last couple of years. Now, Brad, our next slide is going to try to blend cash rent and crop share together. This slide has a lot of variability. Tell us what you see here, Brad.
Yeah, there's a lot going on, and I want to draw reference to the side of the graph that starts at 28%. So we're not starting at zero. But you can see a lot of variability over that time. And if you think about that, the Southern Illinois is less variable than the others, but that's because they only pay about a third. The landlord pays for a third of those inputs, or he only gets a third of the crop. So the tenant gets a larger percentage, so it stays the same. But if you look at the other parts of the state, a lot of variability. We've gone as high as almost 39%, all the way down to those low years of income, where this is how much that the tenant is getting on those returns on a crop share arrangement as a percent of total crop returns. So that's varied from about 30% to 40% over the last from 2007 through 2021. So it's very variable, and it's based off of, the biggest thing is you see that variability is based off those low years that we had. 2009 is a low year, 2015 was a low year, and we can see those run-ups where we had the high years 10, 11, and 12, and then in 2020 and 2021 were the highest peaks of where we were.
This slide to me, Brad, has a little more significance as we shifted away from what we thought for most of my career, the traditional crop share arrangement, to now more cash rent. We're always looking to see, well, how are we doing on that comparable? Let's move to our strategy number 9, uncertainty of farm income. And Brad, our next slide depicts several changes when we look back from just the past decade of how farm incomes have moved along the way. Our first slide here has labor management income. Brad, I've always kind of thought about that as a salary for the farmer. But you can see we have the worst year ever in 2015. And not only the past decade, Brad, but that was the lowest one on a record for our whole history of record database, right?
Yeah, it's the lowest in history, yes.
And then we add the green bar that shows net farm income, which is just another measure of earnings. Labor and management pulls some more things out of the income statement number, but our average over this decade, 154,000. But you can see, look at the variability. We have a loss year in 15, a really strong year in 12, then kind of up and down 15 through 19, and now a couple of really good years here in 2021, and we think 22 as well. But our next slide, Brad, just points up the fact of there's a lot of uncertainty in the past decade and going forward. When we think about the record high in 2012, the record low then in 2015, we eclipsed the 12 record again in 2021, which I know surprised you and me both when we saw those final numbers come in. But now we're projecting a smaller profits ahead for 2023. So there's 4 years in the past decade, 2 records in the right way, 1 in the wrong way, and it looks like we're trending down a little lower. All these mean, Brad, a need for higher focus on management.
Yeah. No, you're right. And so we go to the next slide. We showed you the slide a little bit ago that had the labor and management income compared to net farm income. So it's the difference between the two is very close. So now we take that labor and management income and we've adjusted that for an inflation and go all the way back to 1972. So you can see what that variability has been. And you get that bluish green area from 1980 to 2006. That's a very stable time in agriculture. We had some very low years in there, but the standard deviation, how much it changed from the average, was only about 33,000 year over year. Then we get into that period of time for the run up in the ethanol mandate, that the next section from 2007 to 2012. We had some really high incomes, the highest that we'd ever seen. And then we had a low year in there as well. So a lot of variability. But then since 2012, we've had the most variable period of time. We've gone all the way from the highest at 374,000 in 2021 and the lowest year out of all those years at negative 75,000. That period of time from 15 to 19, it was one of the lowest 5-year periods when you go back and compare it over those other time. It's interesting to note, Bob, the April 2022 projection. You would tell a little bit about what we did there and how we came up with that number?
Yeah, that was an interesting exercise. In April of 22, we, for the first time as a group, asked our staff members at various meetings around the state. Brad had been delivering the 21 results. We said, well, let's think about what 22 might look like. And we did a forecast for yield and price and gross revenue and increased cost numbers. And out of all of that, our field staff groups thought projections for 22 made a year ago now would be lower than 21, but still, maybe higher than 2012 and still a very strong number. So it was an interesting time to do an exercise in forecasting. And so in a month, Brad will figure out how close we came on that. But now that we're in March of 23 almost, what's your first guess on how we think we did?
My first guess is we're as high or above that number. We're higher than that number and probably closer to what 2021 number was. So we'll see here pretty soon. You're right, Bob.
Yeah, early reports from our field staff indicate a very strong gross revenue per acre. So that's number 9, uncertainty of farm income. And Brad mentioned this earlier, but we'll drive this one home a little more. Know what your costs are. That's our strategy number 8. And we're specifically describing non-farm costs here at the moment. These are part of the break-even calculations we do as well, Brad. We do calculations that include family living, income tax, everything you need from a bushel of corn or an acre of corn or soybeans to generate enough dollars to cover all of your costs for this family that we see pictured here in this Kansas wheat field, probably, right, Jim? But know our non-farm costs. Brad, show us what the first one of these is. Family living expendables in 20 and 21, those were down a little bit because of pandemic related pieces, but I'm pretty sure they're going to be higher in 22 when we total our numbers. But our number for last year was 85,000, a little bit over. We also have expenditures for capital items, vehicles, major improvements to homes, things like that. So we're over 90,000 so far. We add in another 25,000 for our average income tax paid by these 1,200 FBFM members, and that gets us to almost $117,000 non-farm costs that have to come from either non-farm sources, Brad, that might be a possibility, but to the extent there is not non-farm revenue, this has to come from the farm production, crop and livestock revenue. This is another cost per acre or cost per bushel to be sure that we get covered. This was the average of this group. Brad, we slice these into high third and low thirds. The low thirds were more in the 80,000-ish range total. High thirds more in the 140,000-ish range total. We have a question for how many kids on this one, Brad? Do you remember that number? It
rounds to about 2.
Yeah, it's like 1.8.
Yeah.
So good luck to that 0.8 of a child there who comes back into our study. Brad put this slide together, slices these into the numbers we looked at on a per acre basis, Brad.
And these are on families 3 to 5 in the family too. This is a little bit different group, but it's still very interesting to look at. So what we're looking at here is the total family living cost plus taxes. And you can see what each one of those little pieces of the slide are. And when you start with that low third, you see that their total family living and taxes is a little over $96 an acre. And they have off-farm income about $56 an acre. So the balance, that $40 an acre, had to be made up by the farm just to meet the family living needs of that farming operation. We move into that average group. You see the difference between the black line and the top number is $54 versus $124. So now that's $70. And then we move up to the top third. This is the top third based off the amount of family living they had. And when you look at that, that is almost, that's almost a little over $90 an acre, the difference on that top high third. But they also have a lot more income generated too in those high third families, Bob.
Right. So you can see some of this cost can be covered from non-farm sources, but everybody has to cover at least some of this from their farming activity. And if these numbers are understated to our slide at the right, if this increases taxable income because these are non-deductible expenses that come from sales of taxable dollars. If you understate this, it reduces your working capital more than you thought. It reduces your net worth more than you thought, reduces liquidity more than you thought. So get a good number in your plan for 2023 so you have a full understanding of these non-farm costs. That's our strategy number 8. It's a big part of the farm cash flow scene. Brad, number 7, we're going to talk about inflation twice. And I put these top 10 strategies together for about 30 years for different presentations. And I don't think I've ever talked about something twice. But I think this is a time where we're going to talk about inflation a couple of times. You see the nice graphic that Jim designed for us here that shows the January 23 number at 300 of our index compared to 100 as our measuring point in 1982 to 84. Brad, I was teaching high school at the 82 to 84 time period. And little did I know, Jim, that would be the benchmark we'd be using 40 some years later. How about that? But look how we've grown that. That means it's 3 times as expensive to live today as it did in 1982. And what else does this mean for us, Brad? It has a good result. Inflation, the first thing it did, it increased our commodity prices. That is a natural result of overall macroeconomics when commodities which have a short duration and a limited supply are affected by inflation, and we have higher prices. But now we get into some of the things that aren't as good. It raises our cost of inputs, and that's going to certainly, Brad, I think we saw a little bit of impact on our 21 result from that, but we'll see a fuller, larger, magnified impact on cost of production on our 22 data and certainly into 23. But we have about every line item that will have an increased cost due to inflation. We're going to have higher asset values on the balance sheet, and Brad's going to show us a little more about that in a moment. But as we have higher land values, we have growing machinery values, higher crop values, we have a larger total asset valuation on the balance sheet. All that means there's more dollars that we want to be sure we can protect. Non-farm income and non-farm expenses are climbing. We hear about this every day as things are more expensive, including wages that employers are paying. So for employees who are receiving that, they should have higher income, but we know their costs are climbing probably as much or faster than those. So overall inflation, in just these 4 brief bullet points, Brad, you can see the impact on the bottom line.
Yeah, it's going to be a big impact on our farms, and it'll be interesting to see what these 2022 numbers come in and then really where 23 is going to end up as well.
Well, inflation is something we haven't talked about very much, but this slide just depicts all the way back to 1975. Brad, I was a high school sophomore. I hadn't got my driver's license yet in 1975. Where were you in 75?
I wasn't even around yet, Bob.
Yeah, I thought you were going to say that. You pick a chart here on the pick a line on the chart, Brad, where you joined us and became economically aware. That's what the phrase we'll use. But look at the 1980s. I was a high school or college sophomore in 1980, and we want to welcome the class from Illinois College and Dr. Ghali, who's joining us today. I showed him this chart a couple of months ago when I visited his classroom, and Brad, a lot of those students weren't there in 1980 either.
Nope.
But look at the difference when I was a college sophomore, and then our IC students and our U of I students on campus today, if they're a college sophomore, they're dealing with inflation in the 6% range, but not the 14 level we had. Brad, almost all of your professional career from the early 90s forward, 4% or less inflation, and a couple of years, Social Security didn't raise it any at all.
Yeah.
So very low number of patterns here, and I've seen the result that half of our population is young enough that they've only seen the bar charts that Jim has here on our screen from the mid 90s forward, and 4% is what is the number we're accustomed to. 6%, they just announced the January rate last week, a little bit over 6%, 2 basis points higher than they anticipated. So we're running, above that into 21. We'll see a little more detail on inflation as we come to a later strategy. Brad, that impacts some of our crop inputs. I'll let you walk through the next few slides.
Yeah, so if we can look at, we talked about how much that increase in those production costs are going to see. We look at here, this is showing some of the input of some of the nitrogen products. Anhydrous ammonia really saw that jump up in the beginning of 2022. We didn't see the full impact in our records because a lot of our farmers had locked in that price if they could ahead of time in 2021 for that 22 crop. But you can really see we've gone from 750 to 1,500. We doubled in a period of time there in just a year and a half. Urea is following that, and then liquid nitrogen as well, but not as much of an increase that we saw in the anhydrous ammonia. Going to some other pieces of the different pieces of nutrients we're including. So we got the MAP and the DAP as well as potash, and those are all trending that same jump up. But we saw that earlier in 21. So we didn't have quite that increase in inflation happening right there. We had some issues there just in the supply and demand, but then that got made even more of a increase because of the inflation pieces that we saw there. And then we really look at diesel prices. We feel this on the farm. We also feel this in the tanks that we're filling up in town as well. So you see that diesel price was at its lowest point there. Probably that's right around March when COVID hit. And then we've gone straight up from there to its highest peak in the middle of 2022. Came down and settled off a little bit, but I think we're going to settle around that $4 for 2023, what I'm seeing here as well.
It's good to see some relaxation on some of these input costs, and our slide only goes back to 13, but we had some peaks like that in 2012 as well when we had higher commodity prices at that time period, but not at the level we're seeing at the moment. One other thing that impacts economics overall, because it impacts the things that we buy, it impacts the profits that we have from the industrial averages here. I pulled the Dow Jones number up. We have just a generally growing number from 13,000 in 2013, almost to 30,000 just before the crash at the pandemic. It dropped to 18,000. Luckily, we didn't stay there very long. We've come back into the mid 30s. We're not back to the peak that we had in November of 21, which was over 35 or 36,000. But we're trying to build a little more steam here. But this is generally, positive, upward moving, and the Dow is always sort of forward looking. And this looks to me like forward looking towards a little more uncertainty, Brad.
You're right.
Number 6 strategy, growing debt, needs our attention. This isn't really a bad slide or bad information that we're going to be sharing with you in a moment, but it does need our attention because inflation will cause debt to grow. But there's some good things that come along with that as well. But just because it's growing, and our first slide, Brad's going to tell us why this is number 6 on the list, is we're at the highest level we've ever been. So it needs our attention. But this isn't a dire component of our discussion. It's just one that demands attention. Brad's going to give us a few details about this debt level being pretty high.
Yeah. So since 1990, we were increasing 4% a year. But as we look at that, during the same period of time, our debt to asset ratio, so it's comparing the debt to the assets, it's improved. It was as high as 33% of our debt to asset ratio was 1991, has gone down now to 19%. So that means our debt is growing, but our assets probably are growing as a faster rate, especially in the last couple of years. You can see that in 1991, our debt per tillable acre was at $258, and in 2021, it was $725 in 2021. And during that same period of time, it's interesting to see, we've talked about those rates. 1991, the interest rate per tillable acre on that $258 per acre was almost $21 an acre. And then 2021, with that much higher debt per tillable acre, it's still only $20, Bob.
Well, the interest rate cut was happening there. So if we take 725 at 3%, that gets me to about $21 an acre. If I take 725 at 8%, that's $56 an acre. So there's an increase of almost $40 an acre, the same math we did earlier. That's part of the reason it demands our attention. Coupled with the higher interest rates, the cost per acre, the risk we're taking is growing at a level that we haven't seen in recent years. Even though the debt level has climbed, our risk is growing a little bit higher here. Now, Brad, here's the good news. We have had asset values grow. Look how much our machinery has jumped in the past decade, Brad.
Yeah, so you look at what your machinery values have done. In 2007, we were at a level a little under $300, and we doubled that in 7 years to 2014 to over $600 an acre. And we've stayed there. We came down a little bit and during some lower income years, but as the price of machinery has gone up, and as well as our incomes have gone up, we're back up to that $600 level in 2021, and I see that going up. I haven't seen a machinery price come down, and plus, since we've seen the cost of used equipment coming up as well, I think that number is going to continue to grow. I can't forecast where that's going to, but we're going to keep going up as well.
Well, we'll surely set a record in 22 for machinery value, don't you think, Brad?
Yeah.
But that's where some of the debt has gone, is to increasing the value of the machinery, increasing the number of machinery pieces on the farm. So we have assets going. That's part of the reason the debt to asset ratio is improving. We are using that debt to buy good assets. Here's another good asset to buy, Brad: farmland.
Yeah, farmland. That one's also done some doubling and increasing. So if you look at the 2010, we were at $1 million on average on our Illinois farms that do balance sheets for us. That doubled in 10 years. So we went at $500,000 in 2003. We doubled in 7 years to get to $1 million. And then we took that $1 million and doubled into $2 million by 2021. So yes, farmland's increasing. The good thing with this, Bob, is that value is increasing, but we've hopefully got some lower rates locked in over that period of time too. That's going to help on that debt as well.
Right. If you look back at any time in the past 5 years, if I jump back a year and any time in the 5 years prior to that, there are many opportunities to lock in long-term low rates. So many of those are still in place. Those are probably not the case with revolving lines of credit, which would be the first thing to increase machinery notes of the shorter life. And again, this is from not just land value increasing, but also using debt to buy acres and increasing the scope of the farm operation. This next slide, Brad, is a really interesting one because it takes this debt to asset ratio and breaks it down by age.
Yeah, so it's when we look at debt to asset ratios, a lot of times people say, well, what should my debt to asset ratio is? It depends. This is showing your grain farm and then by age. And you can see how much, as you look through these, I'll show each age as we go through, but you can see how much more variable are at the farmers at a younger age versus they get the older or more experience in their farming operation. You can see a lot of that. Our debt to asset ratio was really climbing, Bob, during those times after 2012. Especially you can see it in that less than 30 age farmer group. But we've come back down because we higher incomes. So this is where I talked about how much our debt to asset ratio has came down during that time. But this is something that causes me to think about it because we had been using a lot of it and that's been growing a lot. And just, I think the biggest thing is our income came up and inflation drove our values up. And it'll be interesting to see what 22 and 23 is going to show.
Well, debt to asset ratio, a measure of financial risk, and it's fine when people that are younger are accepting higher risk. And I'm in the far right again, Brad. I'm in the 60 plus group. I don't like to take as much risk. And you can see that here. I'm on the 10% range, but interesting to see the change in years and also the change by a farmer demographic. Our next slide is a sort of a relational to debt to asset ratio, but now we're looking at the current ratio pieces, more precisely working capital. There are two ways to think about this, Brad. This slide's going to show us a really interesting dynamic.
Yeah. So we're going to look at two different working capital ratios. One's working capital operating expenses. A lot of times we don't hear that. A lot of times we hear this other one, which is called working capital to gross. And you can see that one is a lot more level through time. That's been growing over time, but the working capital operating expenses has a lot of variability in it because a lot of times our operating expenses will peak up. But also our gross will move at the same time. So a lot of times we'll see that working capital still continue to increase even during those periods that they jump up. So for instance, you look in 2012, we had 91% working capital operating expenses. That was the first time we saw those run up in expenses that period of time with a run up in prices. And then you look to another period of time, which is 2015. That was another year there where we had a run up in some expenses and our incomes were really low. But you look at those are still about the same. We'd like to see that working capital gross on average should be over 30% and the working capital to operating expense above 50%. And we've been there since 2006, Bob. So that's what's helped out our debt to asset ratios as well.
Well, this is dangerous. I'm going to add math on the fly here, but I think if it's a 50% working capital expense, that really kind of means I've got 6 months of my expenses in reserve. Mm-hmm. And that's a pretty good number to make us think about that differently. All right, let's move to our next slide where we've got half of them on the books, Brad. Here's number 5. Do things to get better. Brad, this next slide is one of the favorite things I get out of FBFM data every year as we compare the top third producers and the low third performers and how much difference their results actually mean from various factors. And if you look here between the groups, the yields are a little better for the top third, but Brad, they're not outstandingly different. They're higher. Crop returns, because we now blend in the acre mix, we blend in price, we blend in FSA payments, a lot of crop insurance payments get blended in. But here's our first significant difference. Those, Brad, $130 an acre difference in the high third versus the low third operations that we analyzed. We have some advantages in cost, $40 on crop, $40 on power and equipment. I didn't list every crop item on this slide, but what that combines to, Brad, changes in management returns, almost $300 an acre. What does that mean to you?
That's a huge difference. And the big majority of that is, we did a lot lower expenses to produce a lot more return. So the key, what I see in this is a lower cost producer is going to be able to do better. And that's those ones that are in the top third. And you can see that when you look at that production per dollar non-feed cost, we were able to produce a lot more out of a dollar than what the low third was able to.
Interestingly, both groups spend similar amounts for capital purchase because everybody has, the same eye for getting work done. But for the high third, that'll be a more affordable purchase than the low third, probably paid with more cash, less debt perhaps. So do some benchmarking in your operation and see where you land, because you want to find things to get better. $300 an acre this year was a big difference. Historically, it's been in the 200 or 220 range, but that can have a significant difference over time. We've talked about interest rates, Brad, but our strategy number 4 is, if you're thinking about a transition, and a lot of our farm families are, higher interest rates have increased the cost of making that happen. And our next slide describes from the IRS, they publish rates every month. And look at the changes in December of 22 versus December of 21. Our short-term rates went from 4.55 to up to 4.55. They had been less than half a percentage point only 1 year earlier. The other unique thing, the short-term rate higher than the long-term rate. Not very often that occurs, and I know we have lenders on our group today, and they are well aware of this, but this is a very unique dynamic in farm finance. And Brad, this turns on to a change in the cost to transfer certain assets. Highlight those changes for us.
Yeah, so if you were going to transfer $300,000 of equipment over a 3-year period at that, those two different rates, you were at the interest cost to convert that would be $27,000 in 2022 versus what it was in 21, only a little less than $2,000. So $25,000 difference just to transfer $30,000 over $300,000 over 3 years. And then we look at something even more substantial. We're looking at transferring $1 million of land over 9 years, and looking at those longer rates that we had. You're looking at a cost of $229,000, which only would have cost you about $97,000 a year earlier. So more than doubled in that period of 1 year with those interest rate changes.
And I guess we should point out this increases the cost for the buyer, but increases the benefit for the seller. Interest rates now at higher have generated, revenue streams for investment income that we haven't seen in a long, long time. That's true not only in our farm, but Brad's on a school board, I'm on a college board. We see that in our institutions too, that the higher interest rates are changing that dynamic. This next slide, Brad,
I just want to point out too that this is the cost, the minimal cost to do it. If you have to borrow money, it might be higher than that rate that we were showing there too.
Oh, good point. Yeah, this is the IRS required minimum rate. We use that just because it's a published rate that we can use for our data calculations. These interest rates, if you look at them historically, back to 2006, and I didn't put every year on the slide, but some prominent years here, the short-term and long-term rates were about equal in 2006. They weren't too far apart in 2020, but in 2023, you can see they're far exceeding what the long-term rates are here in January of 23. And the multiples that Brad just clicked forward here, look at this difference. In 2010, the long-term rates were 7 times the short-term rate, 10 times what they were in 2021, both at historic lows, though, in 2021, Brad. And then we jumped it to 4 times, and now the long-term rate let me rephrase that. The short-term rate is only 85% of the long-term rate. Haven't seen that in this whole slide. I'm not sure I've seen that for a very long time in my whole 40-year career, Brad.
Yeah, that's what makes it interesting, times that we're in.
So it has another inflation impact on a transition plan. This is just describing the higher value of the assets that are in your plan to be transitioned, and that might also end up in an estate planning result. This is a 2-year time period, Brad. Look how much things have changed just by inflation impacts on some key farm assets.
I sure wish I was buying those things in 2020 then, Bob, not 2022.
Right. I raised the land value to 18,000 an acre, gross revenue to 1,300 an acre. Machinery went up 15 or 30%. I did lower the stock value because I know my 401k took a hit in that time period too. But still, we went from a $7.5 million transition plan, estate plan, balance sheet, whatever we might describe it, up to $12 million in that 2-year time period. Will that last? Will we have a correction? The question, inverted yield, or more of a comment, inverted yield curve, a harbinger of recessionary events. Well, I think that's what a lot of concerns are, and that's why on this asset slide we're right on now is, will these asset values retain, or will any recessionary pieces cause these values to fall back to 2020 or lower values? Our number 3 strategy, we're going to talk a little bit about tax. We have some favorable tax rules we haven't had for most of my career, Brad, but they've been around since 2018, but they do expire. They're tentatively set to close at the end of 2025. These were the taxpayer, TCJA, Taxpayer Cuts and Jobs Act. And one of these pieces was lower federal rates. Right now, our highest federal income tax rate is 37%. It used to be 39.6%. For the lower tax rates, they're 15% pre-TCJA, and now they are 12%. We also have this thing called QBID. Brad, tell us a little about this.
Yeah, so the QBID deduction, it's 20% of your net farm income, basically, is the way to think about it, based on some other limitations on taxable income. But you get to take 20% of whatever that is, plus your machinery sales, as a straight deduction right on your tax return, Bob.
Never had that before 2017. Effectively, it lowers my otherwise 22% federal rate down to 17.6%. We have higher 179 deductions, which is helped get tax deductions for the rising values of machinery that have been purchased. And we have 100% bonus depreciation. At least we did through 2022. So here's the first example of something that we've had in the Tax Cuts and Jobs Act that doesn't exist anymore today. On January 1, Brad, that changed.
Yeah, it changes down to 80% for any purchases that remain January 1st of 2023 all the way through the rest of 23. And then that changes 20% down every year to 2026.
Yeah, so if we think about purchases in 2024, Brad, they'll have a 60% bonus, meaning that's the amount we could deduct in 1 year, versus a 22 purchase, 100%. And we have one final piece of a higher standard deduction.
And there's
Brad,
a comment that bonus drops from 100 to 80, each one of those 20%, and then just go to zero. Yes, that's correct. It goes to zero in 2020 at the end of 2025.
Yeah, all the way to zero. And there's a lot of questions. Well, will that be the final answer? And we don't know, but we know these are the rules through 2025 as we know them here in 2023. That's not very far away to make sure we're using these favorable rules. We also have a higher standard deduction. That's near $30,000 for a married filing joint couple. In the old days, that used to be a $12,000 deduction. Makes it easier to file your return without having to do itemized deductions. And we have higher federal estate tax exemptions. Brad will see in a moment what that looks like, but that's a big number that we've never had before either. Also scheduled to expire after 25 and roll back to $5 million. Some of the tax planning pieces, just to drive this home a little bit, when I was a high school senior, the marginal tax rate was 70%. And I didn't realize how much, that looked like to higher income folks in 1978. But today that's dropped to 37%. With QBID, as Brad described, we can drop it to 29.6%. Here's the key number. It's a 19.2% effective rate if you're in a trade or business up to about $364,000 of income. Never been that low of a rate on that much income ever, Brad.
No.
It still plays into more tax liability, though. In 1984, when I started my job with FBFM, the average farm paid $3,800 of tax. And last year, Brad showed us in our living study, it's up to 25,000. So even though we have lower rates, the pool of income is much larger. And so the overall tax bill is still a very significant amount. Someone looked up in 1951, 91% on 250,000 of income. So if you had 251,000 of income, you only got to keep $90 of that, Brad?
Yeah.
Oh my goodness sakes. Oh my goodness. All right, let's go on to number 2. We're going to beef up our estate plan. It's a time to think about that. We have higher land values. We have unusual tax exemption and rates. And so because of the higher asset values that we have, we are concerned about estate planning and estate tax liability. Trust might make sense for your plan, but know there are many, many kinds of trust with many, many different kinds of objectives. So, Brad, if someone tells me there's a trust in their business, to me, it's the same thing as saying, I saw cars on I-72 this morning, or I saw vehicles on I-72. There's a whole variety of purposes and types of trust. So understand what those are and how they benefit your estate plan. We'll show a slide in a moment about the Illinois estate tax liability. This is a major concern for lots of our Illinois farm families. There's a $4 million exemption, and it's much easier to reach that level today and have a taxable estate than it was in 2022 from the slide we showed a couple of moments ago. How do you want to allocate to your farm and non-farm heirs? Because your farm assets have escalated at such a rapid pace, your desired division in assets might not be the same today as they were in 2020. And finally, we'll talk about gifting. Is that something that is needed in your plan? If so, there's various types of gifts to do. And we'll see on the next slide, we have a higher exemption to make that happen. Brad, here's the federal estate tax rate. It's 40%. For a long time, it was higher than that at 45%. So it's at the lowest level it's been. There's been all kinds of political rambling on all of these slides. Brad, you can walk us through the exemption levels. These are also the highest they've ever been.
Yeah, so we do still have a high exemption or estate tax rate, but we don't touch that until we go over these exemption levels. So in 2023, you get almost 13 million, 12.9 million per person. And if you're a married couple, you get $25.84 million per couple. So there's a big number there that we have. One other piece that you can tie into that is the 2032A reduction in allowed. So that's with farmland or a operating farm business. You can use that up to $1.3 million to bring that down. So it's another piece of that current exemption level that you get to use as well. And finally, you've got that gift exclusion, what we talked about, Bob. That's that $17,000 that you can give per person in a year, correct?
That's right, and that's been $15,000 in prior years, $16,000 for a couple, but now $17,000. Make that gift to any other person. Don't have to report it to IRS, and there's no gift tax reported. And Jim's suggesting, yeah, you're on the list too, Jim. So let me write you a check here before we leave. There we go. But this stat from 2020, I don't think it'll be repeated in 22. I think we'll have a bigger issue. It's still a relatively small, minor federal estate tax issue for farm families, 0.16%. Even if we take that 5 times the number, we're still below 1% in 2022, but it's certainly growing. But our real issue in Illinois is the Illinois estate tax. Brad, our next slide shows us what that looks like. So let me walk that through just a little bit here. So think of the first column. This is a person who has $8 million in their estate. And if they don't make any gifts, their taxable estate will also be in the left column here, $8 million, and their Illinois estate tax would be $680,000. One of the strategies is give that $8 million away during your lifetime. And if you gave $3 million away, that would make your taxable estate $5 million. That lowers your estate tax in Illinois to $352,000. And if you gave almost all of it away and only kept $2 million, you'd almost eliminate your Illinois estate tax. But you've given $6 million away, Brad, along the way. The point is, this hits our farm taxpayer pocketbook a lot quicker than the federal estate tax does.
Right. That was what, 25 million, right, Bob? So
25 million for a couple, and this is an $8 million per person, or $4 million per person exemption, and $8 million per couple. So here they're over that number and are exceeding the exemption. But Illinois estate tax, another key planning point as you think about your estate plan for 2023. Brad, here's our number one strategy for 2023. It's dealing with this new economy that's so inflation driven. This next picture shows how much this has moved a lot from 2021. I'm sorry, this one is our historical one, yes. 1990. So we have 32 years on this slide. And again, most of the time, 4% or less, except for 1990, until the last 2 years, and even almost a zero and a negative inflation rate in 2009. But a pretty low historical annual rate of inflation, Brad. That's what we've thought about, lived with. Most of our operations, this has been their career. But look at the two numbers on the right, substantially different. Let's drill in that a little deeper, Brad, and look at just the past 24 months. So in the pandemic time period, it was still pretty low, way less than 2%. And a couple of months, almost zero inflation. Well, everybody was grabbing money, stimulus money coming at us from the government, piling it into the bank accounts. Our bank had rapid increase in deposits that came from those stimulus plans. The money was not being spent in that time period, and inflation remained very low. That started to change in March of 21, the first time we're above 2%, and then some steady climbs, leveled off in the summer of 21, which we thought, well, if we can live with 5%, that would be fine. Then in the fourth quarter of 21, we were disappointed when it jumped above 6%, and now 7%. And then into 22, we're approaching, slightly over 9% in June. And the far right bars that have not come down below 6%, that's really changed our economy, Brad, significantly. This inflation trend, we hope it will decline a bit in 23. But as I said, January of 23 was still in the above 6% range. So we're a long way from the green bars of 2020. We're still dealing with higher interest rates to kind of push this inflation ceiling back down a little bit lower. But dealing with these from the farm perspective, the non-farm expenses, Brad, that's our top strategy for 2023. Understanding this, number one, because it's so different for most people in business today, and then dealing with it, number two.
I like orange blue, Bob, but I don't like it in this chart. So
yeah, there you go. We'll look good at State Farm Center last night, right? As we took down the Minnesota Golden Gophers on our COVID delayed ball game last night, but didn't look so good against the Scarlet Red on Saturday. So here's a quick summary of our top 10 strategies for 2023. Higher tenant risk increases that risk, but maybe also profit opportunities. Income uncertainty continues. Non-farm costs, knowing those will help you design a better forward-looking plan. How is inflation impacting your net bottom line? We know it's going to be a big impact, as we've seen on slides today. As the debt grows, it needs our added attention. There are still things you can do to get better and move higher into that top third producer category. We know the cost of transitions are going to grow for our young producers. Our producers who are looking to transition out are now having investment income they haven't had in a long time that will help in that transition. Several tax rules are only around for 3 more years. One of those includes the need to beef up your estate plan in 2023, as well as the higher values. But Brad, number one, inflation economy. And I'll let you close us with the final tagline we put on our slide.
So cash is king. Cash is king for all of these pieces. What we mean there is your working capital. If you have working capital, it's your current assets minus your current liabilities. You've got a lot of flexibility. You can handle a lot of this uncertainty and this growing inflation. You've got some things to help weather that storm, or do some transition planning. Whatever you need to do, you can weather that storm and meet these top 10 strategies.
The balance sheet ratio that Brad showed us earlier, debt to asset ratio, really key to understand what that is for your operation. And then the the married one of the balance sheet and your income statement, working capital divided by either revenue or expenses, that's really what's going to help you determine to what degree cash is going to be king for your operation. Jim, we have one question that's here from our rental slide. What percentage of cash rent land rentals is flex rent? Well, I think that by design will vary quite a bit, but we use a flex rent on a farm that my family owns in Western Illinois. Our target has been 32% of gross revenue. And I know we're going to have a discussion for 2023 if, because of what we just looked at, Brad, the higher cost, does that 32% target need to be lower? We know we've been dealing with larger gross revenues, and our tenant is paying higher operating expenses. So maybe that number needs to be lower. The slide that's most helpful is the one where Brad had the comparison of net share rents. That'll help be a guide towards that. Jim, are we finished with our questions up there? That looks good. Todd Gleason's going to come back and close out our session. Great to be with everybody today. Bob Ray here, Brad Zwilling. Thanks for your time and attention. Hope you enjoyed our presentation. Todd?
And if you do have more questions, go ahead and put them into the question box. We'll get to those in a minute, or we'll close out. I know I have a follow-up question, I think, Bob, for you as well. And you can think about this just a little bit. It pertains to the question you just read, which is, of all cash rents in the state, what percent do you think are variable cash rents? So you think about that. I'll go through some of the sponsors here for our Farm Doc webinars and the website too, farmdocdaily.illinois.edu. They include the TIA Center for Farmland Research. That's here on campus in the College of ACES. And Bruce Sherrick is the director, agricultural economist from the U of I. Compeer Financial, Corteva AgriScience, thank you to them, along with Farm Credit Illinois, the Illinois Soybean Association, FS Growmark, and the Corn Growers. The educational partners include U of I Extension, along with the Department of Agricultural and Consumer Economics, and of course, FBFM, the Farm Business Farm Management folks, who include Brad Zwilling and Bob Ray. Coming up Thursday of this week, we have the final in the Illinois Farm Economics Summit online series. This is number 6. It's the wrap up, and the whole team will be with us, and we'll take your questions. They'll have maybe 3 to 5 minutes where they'll give some final thoughts on all the things that they've covered over the last 6 weeks, or if you happen to be at one of those meetings in Mount Vernon, East Peoria, or in DeKalb. And then we'll take questions the rest of the time. So if you're able and want to join us on Thursday of this week at 11 a.m., we sure hope that you'll do that. You can do that at the Farm Doc Daily website. Just sign up for it. Next week, Gary Schnitke will be back on Thursday, the second day of March, with the second in his crop risk management series. A lot more about Arkin PLC to take up, I believe, in that second in the series. And if you were already at last week's, you're signed up for that as well. Speaking of signing up, is you complete that webinar. When you exit, there is a question about whether you just would like to sign up for all of the webinars that will be held this year and have to do that individually. We'll add you to the list. Just click on yes, add me to that list, and we'll get you at the list, or you can use one of the other 2 answers there as well. You'd rather not, or you've already done it. So we appreciate that. We do thank you for joining us. And let's go back to that question I have. Do we have an idea of how many of the cash rents in the state are actually variable cash rents by percentage?
Todd, that's a great question. I won't know for the whole state. In our database, we don't really collect that, but I think that number is growing. I think that would be a great question for next week or for Thursday to ask the Farm Doc team, because I know they do some information on that. But I think that's a smaller percentage, but it's really growing because it's very attractive to not only the landlord, but also the tenants as well.
There are 2 other questions that have come in. Back to slide 15. Somebody wants to know whether inflation increases commodity prices or whether commodity prices drive inflation.
I think that's a good question. I think, and it's been a long time since I've had my macroeconomics class and my comments about that, but I would be curious to hear from the Farm Doc experts on this topic. This is a good macro comment. So I feel like I'm punting that one. I'm going to answer the next question, Todd, even though I'm going to punt that one. But inflation drives commodity prices, or commodity prices drives inflation. I just know that from my historical learning, commodity prices are probably very quickly impacted by inflation because people are driving more dollars. And, inflation comes from the need to spend fewer dollars at a faster pace, chasing smaller items. And because commodities are such a perishable group, I think inflation pushes them higher. Well, higher levels of crop insurance being more important, absolutely. That was true in 21, 2, 3 as well. 21, Brad, our crop revenue per acre was probably $1,200 an acre range. And 22, we think our crop revenue is going to be maybe pushing $1,400 an acre. 23, maybe back down a little bit, but certainly well above $1,000 of gross revenue per acre. For a long, long time in our data set, Brad, we always thought $800 of crop revenue per acre was the profit number. $900 was great, and we're well above those levels, and we need to be because of the cost we're incurring. So how do you get your position in a state to remain under $4 million? And Todd, I thought this would be something that we might discuss in our presentation at the Beef House in early March. I was just working on that this morning, on what you would do if you have a $6 million estate and you're trying to get your taxable amount under $4 million. Well, a couple of brief ones is you could make larger gifts, but I've always hesitated to do that for a variety of reasons. There are certain types of discounts available that might apply in some scenarios. And 2032A is another way to get your estate under $4 million. And I think it takes, a good FBFM staff person and a good estate attorney can help make that happen. But there are some tools in place that can do that for us. But the real key is you have to start on that early enough so you have time to implement those plans, because some of those you're better results if you have more time available.
Yeah, and we will take those up, as you said, because you're the one that's planning this for your presentation at the Beef House in Covington, Indiana. This is the conference that the Farm Doc team, along with U of I Extension and WILL Radio, willag.org, where I spend a lot of my time has put together. If you'd like to join us there, the cost is just $30. It's a whole day. The agenda is online at farmdocdaily.illinois.edu. You will see it there in the middle of that homepage in blue. It's called the All-Day Ag Outlook, and it's the 7th day of March. It's a Tuesday. Come over and visit with us at the Beef House in Covington, Indiana. This has a deep and long history, started in 1991. And if you've not been before, this is probably, well, I'm sure it is one of the best conferences that you will attend for the winter meeting season, in large part because folks like, Bob Ray will be there from FBFM, and Brad Zwilling, I'm sure, will be around too. Thank you to both of you, by the way, for being with us today. Just a reminder, this has been a Farm Doc Daily webinar. We do thank you for joining us. It will be archived at farmdocdaily.illinois.edu by the end of the day. Thanks to Jim Balch, who's behind the scenes, and our technical director. You have a good day. I'm Illinois Extension's Todd Gleason.